Hello everybody. In this video we're going to take a closer look at the open economy loanable funds model, and we're going to get some insight and also some application. But now let's pause and think of a question that you might have been asking yourself. We might often think of when a country's currency appreciates, that's a sign of its strength. A stronger country, a stronger currency. But isn't a higher government deficit, lower government saving, isn't that a sign of weakness? How do we reconcile this apparent paradox? Higher value for the country's currency with the weakness revealed by less government saving? Well, one potential answer is that the country is well run, or alternatively, it could just be lucky. Investors believe that even though the government's budget deficit is increased, the country is still sound, it's not risky, and investors will still believe that they'll be paid back, and that's why they continue to provide financing at the previous interest rate. Well, that leads us to application 3, a fiscal expansion in an economy that is not considered to be so sound by global investors. Back on the spreadsheet, we can see the same scenario, but now we're going to add a new shock. And the shock is now that our interest rate is going to rise, and here it's going to rise from 3% to 4.5%. So now you can see the piling on of shocks. Not only do we have our previous leftward shift of the savings function, but we also have a higher interest rate. On the savings end, that's going to shift us along this green dotted line. So now savings is going to be a little bit higher than it was in the previous scenario, although still lower than in the baseline. But the important impact here is in investment, because higher interest rates are going to squeeze out investment. And this was such a substantial increase in the interest rate that the savings investment deficit is now lower than it was in the previous scenario, and that means we're going to see this shift of the savings investment balance from the solid gold line now rightward to the dotted gold line. This is going to mean a higher net export balance, lower imports, higher exports, and it's also going to mean a less valuable currency, a real depreciation. So let's summarize here. In this scenario, what's happened is that investors have gotten spooked. They see the country running higher deficits and they say, this country is risky. They need to be compensated with a higher interest rate than previously to finance the country's deficit. We often call this an increase in the risk premium, and this often is associated with a downgrade of the country's credit rating. So in this example, the real interest rate has risen so severely that net exports now increase. We're going to have a lower deficit, and the real exchange rate depreciates. So the big picture here is that as a result of this higher government deficit, global investors, they've been spooked. They're taking their money out of the country rapidly. They're not providing as much financing as they used to. Effectively then, when we have higher government budget deficits in an open economy, this is going to bring on higher interest rates through the risk premium that are going to squeeze out investments. We've added a little bit of realism here. Here's a story from Bloomberg, although we have changed the name of the country to protect the innocent and also the name of the president. But this was a case where a formerly creditworthy country was cut to junk bond status by Moody's Investor Service. Why? Because it has failed to rein in its widening government budget deficit. So here are your key takeaways. The open economy loanable funds model helps us understand both the trade balance and the real exchange rate. All else equal, for a small open economy, a decrease in the external interest rate will mean higher net export deficits, more financing that's provided by foreigners. We call that higher net capital inflows and a more highly appreciated real exchange rate. Higher government deficits can mean large net export deficits and a more appreciated currency, but that's only that provided that external markets continue to provide the same amount of financing at the initial interest rate, and that they have continued to maintain confidence in the country. And we looked at a case where in fact investors get spooked and they regard the country to be a risky proposition because its deficits, its government deficits, have increased or its government savings have decreased.